You've found a home you love and you're writing an offer, but there's competition. You're going to need to offer the right price, but so often it's other non-monetary aspects of your offer that are really going to make it stand out in a crowd. And one of the most important of these is the appraisal contingency. By offering to assume the risk of a low appraisal, which we sometimes call an appraisal gap, you can make your offer much more appealing to a seller. And this can be especially important if you're in competition with a cash offer. I'm Julee Felsman. I've been a residential loan officer for 30 years, and I've helped more than 7,000 families secure loans for their homes. And at this point, I really think I've seen it all. But if I was pressed to name one thing that's the most misunderstood concept in lending, I think it's probably the appraisal contingency. And this is for good reason. It's counterintuitive and confusing in ways that I'll talk about, but once you get your head around it, you'll have this secret weapon in any competitive offer situation. But if you fail to understand it without knowing it, you could be writing a weaker offer than you have to and undermining your chances of getting an offer accepted to purchase a home that you love. And most of the time, an appraisal gap doesn't require more cash. And I think that's one of the biggest sources of confusion. So in this video, I'm going to break down why the appraisal contingency is so important, exactly how the appraised value ties into your loan, how to determine if waiving the appraisal contingency is an option you have, the financial consequences if an appraisal actually does come in lower than the price, and how to accurately assess the risk for you of using an appraisal gap as part of your offer strategy. I'm going to pack a lot into this video, so use the chapters in the caption in the timeline to jump ahead or go back if there's something you want to hear me say again. And first, I really want to start talking about why the appraisal gap is so important. Now, if you boil it down, just keep it simple, buyers and sellers are negotiating two things: money and risk. The money stuff is pretty obvious. It's the price and who's going to pay closing costs and who's going to pay broker compensation and all of these really, straightforward monetary things. Risk is more subtle, but I'd argue it is as if not more important. And this is because market forces are in play. Sellers can sell to anyone. Buyers can bid on any home for sale. Sellers want to get as much cash as they can for their home. Buyers don't want to spend any more than they have to. So this tension means that in a low inventory market, what we call a seller's market most of the time, where there are more buyers shopping for homes than there are homes for sale, sellers may get multiple offers, but still, buyers are often pretty close in terms of what they're willing to pay for a home. Now, this isn't to say that there aren't these occasional outlier situations. Sometimes somebody's going to fall in love with a home and they'll be willing to pay anything that they have to, do whatever it takes to get it. And this video is actually pretty important. If you find yourself in that boat, you're in love with a home, that's definitely going to be, stiff competition. But most of the time, most buyers are going to come to a similar conclusion about the price that they're willing to pay for a home. And this isn't just an idle theory. I don't just think this, I know it. When my clients write an offer, I like to put in a call with the seller's agent. It lets me say all the nice things about their pre-approval and how strong they are as buyers and how well qualified they are and so on. But I also try to get some dirt and suss out the competition. And it's really common when I ask questions about that to hear that there are a handful of other offers that are neck and neck with the offer that my client has made. So how, if you're on the selling side, if you're the seller, how are you going to decide which offer to accept if you have multiple offers that are pretty close from a financial standpoint? Sellers need tiebreakers, and that's where risk comes into play. No matter how much you offer, the seller's going to get $0 if you don't cross the finish line and actually close on the home purchase. So more than just looking for an offer with numbers that they like, sellers are looking for an offer that feels rock solid to close. And this is really the big reason that sellers love cash offers so much. If there's no loan needed, then there's no chance for a problem with a loan. So if you can't pay cash and you need a loan and your loan requires an appraisal, the appraisal becomes part of this wild card that could undermine the seller's payday. And that's where the appraisal contingency becomes such a powerful tool. Your real estate agent will help you wordsmith exactly what goes into your offer, or the forms for the state you're buying in may have some boilerplate language, but your offer could wind up saying something along the lines of, buyer and seller agree that if the appraised value is lower than the purchase price, the buyer agrees to pay up to X amount of dollars, say $30,000 above the appraised value. Or you can take things even further, and you can totally remove the appraisal contingency from your offer. Buyer and seller agree that the buyer waives their appraisal contingency. Buyer agrees to proceed to closing at the agreed upon price regardless of the appraised value. And again, your real estate broker is going to help you wordsmith this stuff. If you think about this from the seller's perspective, you can see why they would love it so much. And if you're up against a bunch of offers, or a cash buyer, or for certain really special unicorn properties, there really may be no option. If you want to be in the conversation and have any shot at getting your offer accepted, you may need to include appraisal gap language in it. And this may feel unfair or unappealing or risky, but try your best to suspend judgment on all those things for just a moment. Let me share everything you need to make a fully informed decision. And while I share everything that follows, I want to have you keep one thing in mind. Appraisals rarely come in low. And I always say this, but before I recorded this video, I decided to pull together some actual data that I could share with you. So between May 2017 and August 2024, two weird dates, but they were dates where I could easily pull some data together. I helped my clients purchase 2,192 homes, and just 4.79% of appraisals came in below the purchase price. And if I leave out the extreme seller's markets that we were in during COVID, 2021 and 2022, just 3.38% of appraisals were less than the purchase price. If you want to understand more about why appraisals don't come in low very often, why they might come in low, more details on the appraisal process, I'll put a link in the caption to another video where I talk all about that. It's good context. But for now, just knowing that, we've established why using an appraisal gap might make your offer appealing to a seller, and that only this small percentage of appraisals actually comes in low. So now I want to talk about how an appraisal gap actually works. And to do this, I want you to learn to think like a lender. We all naturally see the world from our own perspective. You probably worked your butt off to save up this down payment that you're about to pour into the purchase of your new home. That check that you write for the down payment might be one of the biggest you've ever written in your life. So of course, the down payment is front and center in your mind. But we all know that the real golden rule is whomever has the gold makes the rules. So when you apply for a mortgage, it's lenders who have the gold, and it's lenders who are going to make the rules. So we have to shift our focus from the amount you're putting down to the amount that you're borrowing. And instead of thinking about your new home as the place you're going to live in and celebrate birthdays and plant a garden and all the other wonderful things that you're going to get out of homeownership, you just have to think of your home as collateral. Because you're going to pay your mortgage, but if you don't, eventually your lender can take it back and sell it to recover the money that you borrowed from them. So if we start thinking like a lender, what's important is the amount you're borrowing, the value of the property, the collateral, and the relationship between those two things. And lenders have a name for the relationship between the amount they lend to you and the value of the property. It's called the loan to value ratio. No, we're not very creative, but we do love acronyms. So you'll almost always hear lenders call this ratio LTV. The formula for LTV is really simple. It goes like this: loan amount divided by property value equals LTV. And when I'm being lazy, I'll refer to LTV as the inverse of your down payment. And I do say that pretty often, I just don't want you to get too attached to this idea, because although it does kind of work and it's good shorthand, it's also the road to ruin when it comes to actually understanding the appraisal contingency. The LTV is really simple. And let's use an example to get some numbers in here. So let's say you're buying a $500,000 home and you plan to put 20% down. 20% times 500,000 equals $100,000 down payment. Subtract $100,000 down payment from a $500,000 purchase price, and you'll be asking your lender for a $400,000 loan. So far, so simple. Now let's flip this around and think in terms of LTV. We've established that you want to borrow $400,000. We've got a $400,000 loan, and we calculate the LTV by dividing the loan amount by the value. But here's the key question. What number do we use for value in this LTV equation? To your lender, the value is the lesser of your purchase price or the appraised value. When the price and the appraisal match, things are really neat and tidy. Your $100,000 down payment is 20% of your $500,000 purchase price. Your $400,000 loan amount is 80% of the $500,000 value. 100 plus 400 equals 500,000. 20% plus 80% equals 100%. There's order in the universe. But what happens if the appraised value is lower than the price? So let's say the appraisal is 480,000 instead of 450. Your down payment is still 100,000, which is still 20% of the $500,000 price. But now, instead of dividing your $400,000 loan amount by your $500,000 price, your lender is going to divide that $400,000 loan by $480,000, the appraised value. 400 divided by 480 gives us an 83 LTV. Now, in the simplest terms, this means that an appraisal that's lower than your price just increases the LTV. Lower appraisal means higher LTV. So the next question we really have to answer is, what does a higher LTV mean for your loan? But before I get to that, and I want to come back to a problem that I called out earlier. It is so common to focus on the down payment and explicitly or implicitly think of the LTV as the flip side of that coin. And I do it all the time. When I'm talking to my clients, I want to kind of speak in the language and from the headspace of the people I'm talking to, my audience. But when the appraised value and the price don't match, things go off the rails in a way that can be incredibly confusing. So you and the seller negotiate a $500,000 price, and your $100,000 down payment is 20% of that amount, right? But add your 20% down payment to an 83 LTV, and you get 103%. And that can't be right. You're not paying 103% for the property. What would 103% of a house even look like? That just doesn't make sense. But this messy and really confusing math is all over the place. It's everywhere. Real estate agents and even lending professionals, articles all over the internet offer advice about how to adjust your down payment if your appraisal comes in low. And I am here to implore you to completely ignore any of them. Anytime somebody starts talking about adjusting your down payment because the appraisal is low, forget about that. I once had a really, really smart client, literally in tears, trying to build a spreadsheet to work out how a low appraisal would impact the numbers for her loan. So I have two suggestions on this front. One is, let me make the spreadsheets. And I'm serious when I say this. I'm a giant nerd for spreadsheets, and I've already made the one that you want. And it has a name. I call it Scenario-matic. Key in your assumptions, and it'll instantly calculate your appraisal gap, as well as a whole bunch of other things you might want to know, like your monthly payment and your estimated cash to close. It's very cool. I'm super proud of it. My contact information is in the caption, and I lend in all 50 states. You can call me anytime, and if you work with me and my team, we'll make a custom spreadsheet just for you. But if you can't resist the urge and you want to do your own math, here's the secret. Think about your down payment as a dollar amount and not a percentage. Add a $100,000 down payment to a $400,000 loan amount, and everything falls neatly back into place with your $500,000 purchase price. The only time you should think in terms of percentages is when you're thinking like a lender and you're calculating an LTV. So now we've established that a lower appraised value means a higher LTV, and that brings us back to the real question that we have to answer, which is, what does a higher LTV mean for your loan? And the answer is, it depends. And there are 4 possible outcomes, and sometimes more than one of these can apply. So the first outcome, number 1, is nothing. Surprising as it sounds, sometimes a low appraisal has 0 impact. No additional down payment, no change to your monthly payment, no change to costs, nothing changes. Now, it is possible, kind of option number 2, that your closing costs will change. A change to the LTV often brings a change to something called loan level pricing adjustments. These are hidden fees that are built into your loan costs, and I'll put a link above and a caption, a link in the caption to a video that's all about LLPAs. Again, with the acronyms, a change to LLPAs, I should add, isn't always a bad thing. Sometimes a higher LTV actually means lower LLPAs, which can decrease the amount of money due at closing. Now, the third option that can happen from a higher LTV due to a lower appraisal is that we may just need to restructure your loan in some way. If your LTV started out below 80% and a low appraisal pushes it above 80%, now mortgage insurance may come into the picture. Or if you were already paying mortgage insurance, the mortgage insurance premium you're paying may change. Or we may decide to split your loan into 2 parts or change loan programs to an option that's going to allow a higher LTV. And option number 4, and I put this last on purpose, is that you may need to find some additional cash. If all else fails, if you were already at the maximum LTV allowed for your loan, or maybe you want to avoid one of those other consequences, sometimes more cash is required. But I want to emphasize that a low appraisal does not automatically mean that you've got to bring in extra money for closing. More cash is only required if the amount you want to borrow divided by the appraised value puts us at an LTV that's higher than the maximum LTV permitted for the loan that you want. When that happens, your only solution is to lower the LTV to get it back into line with the loan guidelines. And the paths to lowering the LTV, and remember, it's a very simple equation, loan to value, so we can reduce the loan with more cash, or we can try to bring the value back into line with a price reduction or some combination of those two. Now, if you write an offer with no appraisal gap in it, and talk to your real estate broker about these things, of course, you may be within your rights to go back to the seller and try to negotiate a lower price. But if you already told the seller that you're going to proceed to closing regardless of what the appraised value is, then bringing more cash in may be the only path forward, right? So you should talk about a potential appraisal gap and start the conversation around these things well before you're writing an offer. Talking about options for an appraisal gap should happen at the same time that you're getting pre-approved. Some specifics have to wait until you find a property, of course, but you'll be a lot happier and things will feel a lot less stressful, and you'll be way better prepared to make quick but informed decisions if the outline of your appraisal gap strategy is already in place well ahead of time. And there are a couple of things that you want to get into place and understand ahead of time, and these are your resources and your loan options. Your resources are things you're going to be talking to your lender about anyway. How much cash do you have available to put down? What do you want your monthly payment to be? All of those basic things, setting parameters for your loan and your goals. But make sure that you give some extra thought to how far you'd be willing to stretch for your dream home. Could you find room for a little bigger payment in your budget, or would you consider tapping into resources that maybe aren't your first choice for a bigger down payment? Having really solid worst case scenario guardrails in place ahead of time is going to mean you're a lot less likely to get swept up in the emotions and excitement and make a decision that you're going to regret later. And thinking about these extreme cases ahead of time is also going to give you and your lender a chance to really completely explore all the loan options. If I know your goals and the limits of your resources, we can talk through the options for an appraisal gap before you even start shopping. And you'll have this rough outline of how the numbers might look under different circumstances. But of course, the real fun begins when you get out there shopping and you find a home that you love. Now we can put all the preparation that we did to work, and we can answer one more really, really important question, which is, how risky is it to include an appraisal gap in your offer? We need a couple of pieces of information to answer this question. How likely is it that an appraisal on this property, the one you found that you want to buy, is actually going to come in lower than the price that you're offering? And then what impact would a low appraisal have on your loan? And we need your real estate broker's help to answer that first question. The appraisal is an opinion of value derived using a specific methodology that looks backwards to closed comparable sales. These are similar nearby homes that have sold recently, usually in the last handful of months. And where do appraisers get this data on recent closed sales? They use the realtor's multiple listing service. So your real estate agent has access to the exact same sources of information that the appraiser is going to use to create this appraisal report. And that means your realtor should be able to give us a sense of how likely it is that the appraisal might come in low and a worst case idea of the very lowest value that we might see. And with this information, you and your broker can then kind of handicap the odds of a given appraised value, and I can show you what your loan would look like at any combination of price and value that's interesting to see. And this will give you the opportunity to think about all three elements in play when you're making an offer. How much does including an appraisal gap or waiver boost the likelihood that your offer is going to be accepted? What are the odds that your appraisal might come in low? And what are the potential costs if it does? And sometimes when you weigh all three of these factors, the decision is really easy. If you've written the only offer on a home that's been on the market for a month, 2 months, it'd probably be really silly to include an appraisal gap in your offer, no matter how low the odds of a low appraisal or how minimal or inconsequential the cost for a low appraisal might be. But if you're up against really stiff competition, and even a very low appraisal wouldn't have any impact on the terms of your loan, then waiving the appraisal contingency is kind of magic. It's this easy, no cost, no risk way that you can make your offer really stand out in a crowd. Now, if the property that you want to buy is tricky to comp and the odds of a low appraisal look like they're a little bit higher, you should take a long look at the worst case loan outcome and make sure you'd be okay if that's how things turn out. Your situation and your options are going to vary, but if we're working together on your loan, you can use the scenario-matic spreadsheet that I mentioned before that my team and I make to pretty effortlessly stress test potential low appraisal scenarios on the fly as you think about how you want to write your offer. But I thought it might be fun to see how all of this would look in action. So I'm going to build on the numbers that I talked about before and add a few more details and walk through an example that might be a little more real world. So let's imagine that you find a home you love. It's listed for $480,000. Your real estate broker does what they're supposed to do, their due diligence, and learns from the listing agent that there are at least a handful of other offers coming in, and one of them is cash. So if you want this house, you're going to have to write a pretty strong offer. So you talk to your broker, you think about what you want to offer, you decide to go in $20,000 above the list price and offer $500,000 with 20% down. We did the math before. You'll be borrowing $400,000. Now, in looking at the comps, these nearby similar homes that have closed in the last few months, your agent sees really solid support for $480,000, that list price, but the market is moving fast and comps to support an appraisal higher than that look a little iffy. So with this information, now it's my turn to get you some information. And the first thing I'm going to do is figure out if an appraisal is even required. Because sometimes for some loans, if you're putting at least 20% down, we don't need an appraisal report. And sellers love it when no appraisal is needed. You could write that into your offer. And you don't have to worry about the consequences of a low appraisal when there's no appraisal. Plus, you save the cost of the appraisal report and a little time. It's kind of a win-win-win. But let's say an appraisal is going to be required. So the next thing we need to do is compare how your loan would look at a $500,000 appraisal if the appraisal and the sales price match versus our worst case $480,000 value that your realtor is really confident is supported by the comps. Now, we've already done the math for this, how it changes the LTV, but just for the sake of form, let's run through it again. $400,000 loan amount divided by the $500,000 appraised value. If the appraisal comes in at full price, gives us an 80 LTV loan. But if the appraisal comes in at 480, your $400,000 loan amount divided by 480 puts us at an 83% loan. Now, most of the time, the only thing that happens if your loan goes from 80% to 83%, that higher LTV, is mortgage insurance kicks in. And if we assume you have good credit and a debt-to-income ratio below 45%, these are things that affect mortgage insurance costs. That would probably, most likely, put your mortgage insurance premium around 0.1% of the loan amount per year. 0.1% of $400,000 is $400. And that's an annual premium. So if we divide it by 12, the worst case, if the appraisal comes in as low as your broker thinks it can, is your initial monthly payment until you can cancel mortgage insurance would increase by $33. I'll put a link to a video about how you go about canceling mortgage insurance in the caption in case you want to check that out later. But, you know, worst case scenario, $33 a month. So there are two other calculations that I want to do. First, I want to calculate the full range of appraised values that would result in that $33 mortgage insurance premium. Mortgage insurance is priced in brackets, and any loan from 80.01% to 85% is going to carry the same premium. So using a little 8th grade algebra, we can divide your $400,000 loan amount by 85 LTV, the highest LTV that's going to generate that same $33 a month mortgage insurance payment. And then we'll round up to the nearest dollar. So $400,000 loan divided by 85 LTV, rounded up gives us $470,589. So what we just figured out is any appraised value that's below your $500,000 offer, $400,000, $999,000 or lower, down to at least $470,589 would result in the exact same $33 a month mortgage insurance premium. Next, the other calculation I want to do is to figure out the maximum appraisal gap. To do this, we divide your loan amount by the maximum LTV the loan program allows, and then we subtract that number from your purchase price. So let's say you're a first-time home buyer, and most commonly that would mean the maximum LTV for your loan would be 97%. A $400,000 loan amount divided by 97%, rounded up again, gives us a $412,372 minimum appraised value. So if we subtract that, $412,372 from your $500,000 purchase price, that gives us an $87,628 maximum appraisal gap with no additional cash out of your pocket. Let me know in the comments if this surprises you. What sort of pulling this all together, if you offered $500,000 and the appraisal came in at this ridiculously low level, let's say $413,000, over $87,000 less than your offer, almost $68,000 less than the list price, your loan would be fine with no extra money, no extra down payment needed to cover the appraisal gap. Now I should add that with an appraisal that low, we would have to talk about a different mortgage insurance bracket and the premium would be higher, but still no extra cash out of pocket. So with this information from me, now you and your real estate broker can decide how to write your offer. If you feel okay rolling the dice that you might have to pay a $33 mortgage insurance premium that would increase your payment, you can offer an appraisal gap down to $470,000. That's $10,000 below the list price that the seller was originally asking, $30,000 below your offer. Or if you really want to go toe-to-toe with that cash offer that you know is coming in, you could think about entirely waiving your appraisal contingency because, again, you don't need to pay any extra cash out of pocket so long as the appraisal comes in at least a little under $413,000, which is just going to be a silly number. Now, I would suggest before you sign that offer, doing one last thing. Take just a second and do a little gut check. Once the seller accepts your offer with that appraisal gap in it, or if you decided to do a waiver, the waiver of the appraisal, you are contractually obligated to those terms. Not very many appraisals come in low. Over the last 7 years, less than 5% of my clients' appraisals have come in low, but some do, and yours could. So aside from the $33 a month, how will you feel paying more for the property than the appraised value? Understanding the appraisal process and why some appraisals come in low is really important context for this thought exercise. So make sure you check out the video that I linked in the caption as you think about this part of things. If you think about it, and the idea of paying mortgage insurance just bugs you too much, I want to share one last calculation, and then I promise I will be done with all the math. there is a simple formula that you can use to calculate how much cash it would take to close an appraisal gap if you either want or need to hold the LTV constant. You just multiply the difference between the price and the appraised value by the LTV. So let's say you don't want to pay the $33 a month in mortgage insurance and the appraisal comes in $20,000 low. 20,000 times 80% gives us $16,000. So if you write in that appraisal gap and the appraisal comes in at 480 instead of 500, you've got two options. You could stay the course with your $100,000 down payment and pay the $33 a month of mortgage insurance, or you could increase your down payment by $16,000 to $116,000 to avoid mortgage insurance, and it would totally be your call. Now, this calculation becomes much more important if you're at the maximum LTV your loan allows. So let's say you want to put 5% down and the maximum LTV for your loan is 95%. If your appraisal comes in $10,000 lower than the price, then $10,000 times 95% LTV is $9,500. And if you don't have any way to come up with an extra $9,500, then you really can't write in an appraisal gap to your offer. Now, if all of this feels way too mathy and complicated and a little overwhelming, don't worry. You are not going to be on your own. You honestly can't be on your own. Even if you watched every second of this video and you took really great notes, there are things here that you just can't do yourself. You need a lender to sort through loan options, to research mortgage insurance premiums, to help strategize. And if you're working with another lender and they don't seem to understand this stuff, don't hesitate to give me a call. If you've gotten this far into this video and you're still watching, you're clearly my kind of people and maybe we should talk. And if you work with me and my team, remember that we're going to build you this scenario-matic spreadsheet and it'll instantly do all the math for any offer that you're thinking about writing. So I want to close things out with a few, no more math, higher level principles that you can keep in mind. The more cash that you can put down, the bigger your potential appraisal gap. On the other hand, the tighter your cash position, the less cash you have available, the more limited your options are going to be. Loans that allow a higher loan-to-value ratio often offer more room for an aggressive appraisal gap in your offer. Mortgage insurance, and this may be a little bit of a surprise, could be your new best friend. It's really an amazing tool. It probably costs way less than you thought, and it's usually cancelable. And if you're buying your home with an FHA, VA, or a USDA loan, there is something a little tricky, which is a mandatory appraisal escape clause. And that makes appraisal gap strategies a little bit trickier. That's probably a topic for another video. Now, you can't work out all the details until you find a property, but it's still really important to plan ahead. Get to know the market. Talk with your real estate agent about how competitive offers are for the types of homes that you want, and explore all the elements you can use to strengthen your offer, and specifically how important an appraisal gap could be to your offer strategy. Then strategize with your lender. Make sure they're knowledgeable and prepared to support you. If they don't bring up the appraisal contingency before you ask, or tell you that a low appraisal always means you're going to need more cash, honestly, your lender could be putting you at a competitive disadvantage. And make an offer day plan. What's your lender's availability to answer questions and run numbers for you, and your broker when you're ready to sit down and hash things out and make an offer? And make sure your broker feels comfortable assessing the comps and giving you a feel for the likely worst case appraisal numbers, because your lender can't run numbers without that information. And then do a gut check. How are you going to feel about potentially agreeing to pay a higher price than the appraised value? This is a really hard question to answer in a vacuum. It gets a lot easier when you have a specific home in mind, but try to give it a little bit of thought ahead of time. And remember, you need the support of a lender. So call me anytime if you have questions or you want help developing your own appraisal gap strategy. My contact information is in the caption, and I've included links to a few related topics in there as well. Thanks for watching, and I look forward to seeing you in the next video.